Hello, everyone, and welcome to another episode of Coffee with Carl. I'm your host, Carl Zoellner, one of the attorneys here with Anderson Business Advisors. I've got my coffee today. Today felt like an espresso day, so that's why the cup is so small. Today I wanted to take a chance and talk a little bit about real estate professional and qualifying as a real estate professional and some of the ins and outs and the actual language that the IRS uses and what the benefits can be. Qualifying as a real estate professional can have some huge benefits, especially if you have a lot of active income you're looking to offset with passive losses that normally wouldn't be able to be applied in full to that active gain. So first and foremost, I want to focus on the actual language. So I want to take us over here to IRS publication 925 so we can look at the actual language and talk about some of the definitions and how we break this language down, because as you'll see pretty quickly, some of the language can be a bit dense. You'll see here I've highlighted in green. I could just left it black and white or, highlighted it in gray, but, colors are fun. So we're going to use green. Real estate professional, as described in the publication. Generally, it talks a little bit how rentals are classified. So let's read through this real quick here. Generally, rental activity are passive activities, even if you materially participated in them. So we've got a first definition here of materially participate we'll need to look up, which I've also highlighted and we'll go over as well. However, if you qualified as a real estate professional, rental real estate activities in which you materially participated aren't passive activities. For this purpose, each interest you have in a rental real estate activity is a separate activity unless you chose to treat all activities in a rental real estate activities as one. Okay, so there's 1, 2, 3 sentences here. We broke down number one is we need to look at materially participated. Number two here says, if you qualified as a real estate professional, rental real estate in activities in which you materially participated aren't passive activities. So what does that mean? It means if I'm materially participating in my rental and I want to qualify as a real estate professional, I'm no longer classifying those activities as passive. The implication of this is reflected in the passive activity loss rule, or PALS, and it normally means you can offset passive gain with passive loss, but it doesn't fully extend to when you're generating active income. You can only usually take a very small portion over to your active income. So what we want to do is, as a real estate professional, if you qualify as a real estate professional, you can actually apply those passive losses in full to your active gain as long as you qualify. So this is how we're going to offset active gain. So say a high W-2 earner, something along those lines, against our real estate losses. So let's scroll up here a little bit so we can read a bit more here. So this is the rule here you see with the circled red items is basically the qualifications on how you qualify as a real estate professional for the year if you meet both of these following requirements. I'm going to read it first, how the IRS writes it, and then I'm going to show you how I break it down. So as they write it, number one is more than half of your personal services you performed in all trades or businesses during the tax year were performed in real property, trades, or business in which you materially participated. Once again, we see this materially participated word. I'm going to go define that right after this, but let's see the second part of the test. You performed more than 750 hours of services during the tax year in real property, trades, or businesses in which you materially participated. Okay? That is the two-part qualification. Down here talks about ownership. So if you're, say, a real estate broker, it becomes more applicable to you. But let's break down this little test here, okay? So first of all, I think it's important, like I said, for the definitions. Let's look at the definitions of what we see here when we say real property, trades, or businesses in which you materially participate. So let's look at what a real property, trade, or business is, and they define it below here for us. So a real property, trade, or business is a real property, trade, or business is a trade or business that does any of the following with real estate property. So it could be development or redevelopment, construction or reconstruction, acquiring, converting, renting or leasing it, operating or managing it, or brokering it. So those are your definitions of what the IRS considers a real property trade or business. Most of you who are real estate investors fall into one of these categories in some way or another. If you manage your own properties, is pretty much a direct line to that, as long as we go back up to here, more than half of your personal services you performed, so more than 50%, are in that trade or business. Now, when we talk about more than half of personal services, a good example would be, say I have a bike repair shop, okay? I believe Toby's used this example before. If I spend 1,000 hours on bike repair and 1,000 hours on real estate, I do not qualify because it's not more than half. If I spend 1,000 hours on bike repair and I spend 1,001 hours on real estate, now I've used my personal service time more than 50% or more than half on real estate, so now I can qualify. There's these little things that you have to do. There's a lot of if-then statements that come down to this, but usually a direct line for clients is going to be, I own rental properties, I manage rental properties, this is myself or my spouse's qualification or able to qualify as a real estate professional. This is the scenario which usually occurs, or which is most common from our perspective, is one spouse may have a high W-2 job, the other spouse may be stay at home, but does some work on the real estate portfolio or the investments. You can actually qualify one spouse as a real estate professional and the other spouse does not have to qualify, but if they're married filing jointly, can still take advantage of those real estate professional income offsets when we talk about passive losses against active gain. We have a friend of the firm who's a litigation attorney. He does quite well for himself, did about $3 million from his attorney practice. His wife qualifies as a real estate professional, and in the year where they were making a bunch of money, they'd bought a bunch of real estate, did a accelerated depreciation on it, and was able to offset that entire active gain from the attorney's legal practice with the real estate losses because the wife qualified as a real estate professional. The IRS even challenged it. They lost because the rules were followed as set out, so they got to take it against the client's active gain. So pretty interesting that you can do that, and there's some pieces that need to be calculated to make sure it makes sense. And like I mentioned, here is the test. So let's look at. We talked a bit about what is materially participated. So let's go up here where it actually defines material participation, and we can look. So I put red check marks. There's actually 7 parts or 7 tests here that you can actually qualify as material participation. I put check marks next to the 1 through 4 are the ones we tend to use the most, and those are the ones that are most common to our clients. However, just because these are the most common doesn't mean you couldn't fall under the other tests. I just chose to show you this one, and I'll pause on this for a second in case you want to read it. I'm not going to read through the whole thing on this portion because it sort of is just a definition part. But I want to go back to the test here in just a second so we can look at and sort of summarize this whole deal. Now that we have definitions to everything, what does it look like, or how do I look at it? So when I look at qualifying a client for real estate professional status, the first thing I actually look for, so it's a 2-part test by the IRS. I actually break the test into 2 parts as well, but I do it a little bit different. First thing I want to look for is material participation. Do you have material participation in the properties? Or if you're a broker, do you have that ownership requirement that's below in red? Then I start to look at, okay, so what percentage of your personal services did you perform in that real estate property trades or business? Is it 50% or is it, or excuse me, more than 50% or less? If it's more, great. And then finally, more than 50%, this second part you see sort of circled as 2B becomes almost, I don't know, almost mathematic in that if you're spending more than your half of your personal service time, 750 hours isn't a huge bar to hit, but just take a look to make sure we went to 750. And how do we verify that? Just moving forward, like anything in tax, we want to document our time if we're going to claim real estate professional status. So in case it gets challenged, there's backup for it, just to make sure we're on the right page here. So let's go back over to this last third sentence here with real estate professional. For this purpose, each interest you have in rental real estate activity is a separate activity unless you choose to treat all interests in real estate activities as one activity. So what is that telling us? It means, and we have seen other CPAs miss this before, is that you have the ability to aggregate all of your real estate activities under this real estate professional status versus having to qualify on a per property basis. Okay. This is one, like I said, sort of one of those things that happens behind the scene when Anderson is working with you or tells or wants you to or says that you may have the get some benefit out of qualifying as a real estate professional. But I think it's important to note, since we went through the other two sentences, broke down the definitions, and went through what it takes to qualify as a real estate professional. So that being said, the summary is qualifying as a real estate professional can be great, but there certainly is a test and definitions. You need to work with somebody who's aware of them to qualify you, or you can read through this and try to do it yourself. That would not be my suggestion, especially if you're not used to doing it, simply because it's a low value activity in which you could be spending more time doing other things, making money for your business versus banging your head against the keyboard and trying to parse these things together. I think it's fun to go through some of these every once in a while, and I want to do this on an not all the time basis because my goal is to keep these videos short, and at this point it's a little bit longer than usual. But I think it's fun to show you how we break things down as well. And we always like to talk about or be transparent in the why and how behind why we do things. So until next time, this is Coffee with Carl. I appreciate the viewership, and tell your friends, and make sure you subscribe to our YouTube channel and take advantage of all of our free content. Of course, Toby's Tax Tuesday is always great, and Toby goes over a lot of these things, but I think it's nice to sort of separate them out and go over them specifically. If you have any questions, as always, please give us a call or reach out to us. We're always happy to have a free consultation if you're not yet a client, or if you are a client, always happy to speak with you if you're using our Platinum service. So please, please, please enjoy the free content and comment and subscribe. Thanks.